Okay, once we start again. Ladies and gentlemen, welcome to a new week and a new dollar. Maybe we can salvage some of today's presentation after the computer broke down. Risk is on, equity in Asia was green. The continued talks between China and the US will carry on from May 15 through 19. Trump administration not being prepared at the moment, but Trump tweeted over the weekend that he's doing a U-turn on the 7-year ban for Chinese telco company ZTE, and that is a token of goodwill towards China. So an interesting development which caused risk on over the overnight session. EU is looking for a 6-month extension period to the Brexit transition as part of the withdrawal agreement. And we had some negative headlines out of the UK by the Brexit guy in charge who said it looks pretty weak. And it's a big goat screw up, as we would have said on the trading floor, because both sides are not really well prepared. We need to keep that in the back of our minds for the pound. Italy, Italy 5-star, and the League are reaching an agreement. They still need to decide on cabinet members and who's going to play the role of prime minister, but interesting development there. Malaysia had a peaceful regime change after decades of nepotism and negative developments. The risk assets opened lower after a holiday, but recovered quickly as fears are easing in the market. Interesting. Then we have new supply coming online as we keep an eye on the increasing Baker Hughes total rig count in terms of oil supply. Oil is below 71 per barrel in terms of the WTI front month contract. Keep an eye on that because there's more supply hitting the market. Technology is getting increasingly efficient also for the fracking companies in the US. And or on the back of it, we have the situation that the positioning is extremely short by the relevant party in the market. Take a look at the CFTC positioning report. North Korea in a ceremony is going to take down its nuclear test site May 23 through 25. And in the first attempt of this morning meeting, I said, I recall my dad calling me on a daily basis last week asking me when the nuclear war was going to start. And I calmed his nerves down by stating that risk assets were flowing into South Korea and the smart money wouldn't go into the South Korean risk assets. At the time, the stock index was at an all-time high. If smart money would have perceived a quantifiable threat for a nuclear disaster in terms of a war over there. So as I always teach, follow the money globally and stop reading headlines by people who don't know what they're talking about, or i.e. follow relevant information, but not interpretation. Find your own trades, do your own analysis, because the more you follow others, the more you're hindering your own ability in becoming an independent trader. US yields 530s continue to flatten to fresh decade lows. The June rate hike probability by the Fed via the short-term Fed fund futures currently priced in at 100%. So that one is in, but the probability of 4 rate hikes for this year due to the weaker inflation numbers last week in the US came off a little bit. And then we have the Trump administration, and on Friday they released their blueprint on how to lower drug prices by eliminating the middleman. You can imagine what happened to the equities there. NAFTA deal. There were some positive progress reports from the Canadian and Mexican participants, and they said they could reach a final deal by May 17, but we already had some conflicting reports over the weekend. So this is the headline situation. The trade that was still open from last week was short Euro Canadian dollar. At the time, this was our picture, and it worked out. It was another winner. So 86 pips on position 1, 131.3 pips on position 2. So far, we traded year to date 23 positions, 16 were winners. So we're hitting at 70% average, which is quite good, and the account is up. And it's interesting because it's only one trade per week on a Monday, and Monday is construction day, so I'm working under extremely difficult circumstances. It's much easier to decide on trades on a Monday evening after the US close, because then you see the big boys being positioned. Nevertheless, 70% with one arm tied behind my back's okay. Strength versus weakness this morning, as we can see, New Zealand dollar weakness. This is due to positioning, and Governor Orr last week clearly stating, guys, equal probability for the next move in terms of rates up as well as down. And then the market really liked his transparency. That was well received. Pound and euro recovering. This has to do with reallocation of portfolios because we both had well, it's a little difficult to explain. So let's leave it at that. Repositioning of portfolios. In terms of risk events this week, what are we seeing? Monetary policy meetings overnight out of Australia. German preliminary GDP Q&Q, a little bit worse than expected. And since it's preliminary, it's leading. I thought it was quite interesting. Then out of the UK, we have average earnings index that is of interest to us because we want to see if labor is actually getting paid for their work, paid more for their work or not, and that is expected a little bit weaker. And then we have the claimant count that is expected to come in a little bit higher than last time, and the unemployment rate is expected to remain unchanged. I'll talk more on that in a second. Euro, we have flash GDP, also expected to come in line compared with last time. Out of the UK with the inflation report hearings. The inflation report came out last week, if you may recall. In the US, we have core retail sales expected to come in higher for core, and on the month-on-month headline figure, lower than core. Here too, we will speak on in a little bit. A couple more points. And then we have, for New Zealand, always relevant, the milk price index, GDT price index. And then on Wednesday, Thursday, Friday, Wednesday, we have preliminary GDP out of Japan coming in a little bit weaker than last time. And we have in Australia the wage price index. So here again, where is global inflation? That's the big question. Out of the US, a leading indicator, the building permits expected to come in line, or not in line, expected to come in as high as last time. And then we have capacity utilization rate coming in probably a little bit higher than last time, in industrial production the same. In terms of Australia, we carry on. Employment change, roughly 15,000 more jobs than last time. The last two readings were quite weak. Recall that 2017 was a blockbuster year in terms of creating new jobs. So it's interesting for us to see what the developments are shaping up to be in Australia. Unemployment rate expected to remain at 5.5%. Kiwi will hand us their annual budget release that is of interest to us. And then another leading indicator in the US, the unemployment claims coming in slightly higher, but we all know the US labor market is doing extremely well. Friday, we have CPI numbers out of Canada. I got some numbers from some banks for you because, as you can see, there's no forecasts in here. So let's get into the nitty gritty, and then we hit the trade of the week. Okay, please, dear computer, carry on. Thank you. Dollar NAFTA negotiations, we talked about that. No, we didn't. We only said that they're looking to reach an agreement by May 17. The stumbling block is the auto content rules. That's of major importance, so we'll see if they come to an agreement there. The risks currently are also skewed towards missing the deadline, and that would imply some weakness in the Canadian dollar. So if you're sitting in front of a squawk and you're listening to headline news hitting the tape, there may be some very good scalping opportunities. If you hear that the deadline will be missed, then hit the Canadian dollar because it's probably going to go down, meaning US dollar CAD rising. Latest inflation data week, so assumptions are for 4 hikes, the latest inflation data out of the US is cooling off the assumption of the market for 4 hikes in 2018. And then on Tuesday, we have core retail sales, not 5 versus not 2, and retail sales month on month, not 4 versus not 6. Why? Softer vehicle sales on the one hand, but higher gasoline prices evening that out on the other hand. Retail sales growth slowed to 1% annualized according to Capital Economics. Great research tank, by the way. Tax cuts benefits and a strong labor market are leading to an expectation that the second quarter GDP growth will pick up again. This is what we need to focus on. This is what the market is expecting currently. If you see that flash numbers for GDP growth Q2 come in weaker than expected, that US dollar may come off again, meaning it will see weakness. Canadian dollar, on Friday we have inflation numbers in form of CPI. Here we had some significantly higher gasoline prices for the Canadian market, and that led to the expectation that the CPI in March will come in higher than last time. Last time it was not 3, this time not 4. So the link here is the higher gasoline prices. And this number, not 4, is implying a year-on-year rate of 2.3% increase. Now, please recall the following. This is specific for the Bank of Canada. The Bank of Canada's core measure are common CPI, trimmed CPI, and median CPI. And the average of the three is currently, or was in March, 2%. And then in the last NPR communication around April, they emphasized, the Bank of Canada, that they have a target band of inflation of 1 to 3%. So 2% average of the averages is right in the middle there. So the market currently is not expecting a strong reaction by the Bank of Canada if inflation were to increase above this midpoint of 2%. Did you get that? So if you see a retail number above 0.4 and you're starting to buy the Canadian dollar, the pros will fade that move. They will know that uninformed traders are buying that higher retail number, and they will hit you in the face if you buy it. If it were to happen, it'd be really interesting for you to watch that live in the chart or in retrospect when you come home after work. Friday core retail sales not 6% month on month according to RBC, and last time it came in at flat. So this is also on the back of a rise in auto sales. So get this, in the US we had really bad auto sales, especially in the secondary market, in the used vehicle car sales. And in Canada we have the opposite. That's interesting to note. The expectation of the market is for a bounce back in consumption in the rest of 2018 to roughly 2%. Yeah? So if consumption doesn't come back, inflation is not going to rise further. And the Bank of Canada currently is what we call data dependent. They are waiting for new information based on economic developments to make up their mind if they're going to hike rates one more time this year or not. In Euro, we have a similar interesting information because we have the CPI year on year expected 1.2 versus last time 1.2, and the month expected to print at 0.3 versus March 1% reading. So this is lower in terms of CPI reading. I know it's the final, it's normally not as relevant, but this time the market will look at it, and that is why we're bringing it up. Why? These figures could cause some concern in the market that the ECB's normalization efforts are being hindered by inflation that's not really materializing according to the ECB's expectation. So now the market is watching and listening to comments from any of the ECB officials hitting the mic. How are they going to downplay the slowdown in inflation and economic growth? Okay, and the market will focus towards the end of this month on the flash print for CPI and GDP. Important to know so that you can determine on which day to trade and what economic numbers to look for, because you want to look at the same thing that the professionals are looking at. Pound, MPC, please recall, kept rates unchanged last time and the vote split was 7-2. We had 2 dissenters. Now, we had very weak recent economic numbers, CPI and GDP growth, and that led to rate hike expectations to be priced out of the market. The market was positioned, and the pros were all positioned for a May rate hike, and then it took less than 2 weeks to take the expectation from above 80% down to 0 or below 10%, and that caused a massive weakness in the pound. Then we had Carney hitting the tape, saying, "Excuse me, Mr. Market, you misunderstood me." Catastrophe. So during the press conference, the journalists were beyond themselves. I'm exaggerating a little bit. And they said, "What is this mess? What is this really poor communication? First, you're guiding us towards a rate increase, a rate hike. And now you're telling us a few days before the proposed rate hike date, there's no rate hike coming due to weak numbers." So Carney tried to do a good job in rectifying the situation and telling him, hey, we're just reacting to data. We always says we're going to react to data. Anyhow, now the focus will be on the revisions to the first quarter GDP growth number out of the UK. If the revision comes in lower then the Carney and the MPC will be rectified. Yeah, they will have done the right thing. If it doesn't, the revision come in lower, the market is going to be quite upset, and Carney has a problem then, because the central banks, it's very important to them that they have a very clear communication with the major market participants on what they're trying to do, when and next, and how they, what their expectations are in terms of the economic growth and inflation expectations. On Tuesday, with the labor report, average earnings, super important number, expected to come in slightly less. Unemployment rate expected to come same as last time. Now the market is trying to determine, hey, when are you going to hike again? Is it going to be in August or is it going to be in December? What's happening here? And the BOE says, hey, we're data dependent. So it's all now back to currently the communication stance where they're saying, hey, the slowdown in Q1, it was the bad weather, it was the snow, it's all temporary. Now imagine what happens if the GDP growth numbers come in weaker for the second quarter. The pound will get hit again. Now, if they come in line again or slightly better, it's a buying opportunity for the pound. Always note, though, that you have Brexit risks headlines in the back. Okay, Brexit can always mess up our trades. Aussie dollar, Tuesday monetary policy meeting. Recall, they kept rates unchanged last time at 1.5. Governor Lowe said, hey, not seeing really a strong case for near-term moves in rates. Nothing new expected out of these minutes. Aha. But the same day, the deputy governor, de Bell, is speaking and making comments about the outlook for the Australian economy. Last speech by de Bell, there were no comments made. This speech, maybe there will be some interesting comments that will guide us. It's important because we like the Australian dollar currently. Then on Thursday, we have employment change. Like I said, 15,000 roughly more jobs expected, unemployment rate in line. And then we have the NAP business conditions index, which rose 6 points to plus 21. And that is the equal highest level since the survey began in 1997. So that gives us a leading indication that the employment change numbers will be okay. Now, 2017, unbelievable development. Last two numbers came in really weak. So this number will be of importance to us. NAP is noting that the employment conditions posted strong gains in the month, and they expect the labor market to continue to improve. So guys, we have the US super well in terms of GDP development currently, and we have Australia. Everybody else, including their central banks, is coming off a little bit from their tightening intentions. They all tried to tighten. They all said, hey, we're beyond the hump, it's all going well, beyond the trough, I should say. Economic development and expansion is increasing. They're all coming off a little bit. So there's two currencies that you rather want to replay from the long side, and that's the US dollar and the Australian dollar. Yen, real quick, preliminary GDP flat versus not 4. And we have some forecasts in the market that expect even a contraction due to a fall in private consumption. And they're making that assumption because the Bank of Japan's consumption activity index recorded a 0.4 Q&Q drop with a decline in capital goods shipments. Now, can you imagine what the investment banks are looking at? They're looking at capital goods shipments, then they're looking at a Bank of Japan model in terms of an activity index, and that's dropping, and then they say, hey, we expect a really worse number than even no growth for the Q&Q GDP. That's why this week we're liking the yen out of the short perspective. So you should already know what type of trade I'm looking at. Hey, Mr. Computer, please stay with me. Thank you very much. Real quick, CFTC cut positioning. Aussie on its way to a long signal. Maybe this week the long will fire. Okay. Swiss on its way to a long signal. Really interesting comment this morning by one of the central bankers from the SMB. You can read this up on yourself. Volatility is coming off across the euro, the pound, the yen, and even the VIX. But 100-day realized volatility in US equities is still around 18. And 18 is still high enough that the risk parity mandates are net sellers of equities. So we need to keep this in the back of our mind that the US equities do not have a buy the dip systemically based on passive investments behind them. Now they have headwinds in terms of these passive investment mandates that are now net sellers due to still their rule that high teens means we are net sellers of equities, high teens in terms of 100-day realized volatility. Okay, option pricing. Bullish Monday, euro dollar and pound dollar, so cable, and we've seen that both started reacting bullish this morning in the London session. Option flows are bullish for the London session. Aussie, Canadian dollar, and gold. Gold obviously very, very determined by the dollar weakness right now. Dollar strength versus dollar weakness. So we had the DXY below 92.50, and hence we saw gold react positively slightly to it. Bearish on Monday, we have the pound, the euro, the yen, and the Swiss franc. Positioning, you can see here net positioning of the US dollar. The historic short by the buy side, by the real money side, is coming off a little bit. But now we still have a historic short by the buy side in US Treasury futures. So please do not be alarmed if yields come off in the US, okay? Because the majority can't be right. If everyone is short, including my mom, who's going to short next? That is always the question. And the market exists to incur the maximum amount of pain to the maximum amount of participants at the most unopportune time. Actually, that reminds me of my friggin' computer. My computer is like the market. It inflicts pain at the most unopportune time. Potential trade this week, long Aussie yen. Aussie, we have positioning, we have positive economic developments, and we have labor market numbers on Thursday expected to come in better than the last couple of times. Yen, we have extreme positioning, still not extreme, coming off a little bit, but positioning is relevant, and we have slightly negative economic numbers expected on Tuesday in terms of bad GDP growth, might even come in below expectation currently. The trade structure is 2 limit buy orders. I am looking to long at 82.50 and at 82 the figure, and I'm looking to take profits at 83.25. The risk for my trade is that we have risk off sentiment leading to Japanese yen inflows and Aussie dollar outflows. And risk off, there's a lot of stuff on the radar that could already cause risk off, like the China-US trade talks, the Brexit, the NAFTA, the Iran situation. So a crap load of already relevant items on the radar. What happens if something comes out of left field that we do not have on the radar yet, and that could really negatively impact the sentiment? So we need to keep an eye on that. And or we have commodity weakness, and that would then translate into further buy side short selling pressure in terms of the Aussie dollar, because the buy side is extremely short and they're looking to currently continue as they are trend follow us. Okay. Here's a picture of the trade. Unfortunately, due to the computer crash, I can't show you the live chart, but I think this is a 4-hour picture. Take profit up here at 83.25, and then the long limit here. Problem is already touched it once. We'll have to see, but I cannot buy, I have to buy value. I don't buy retail. This is retail price, so I need it to come back. And then the second add-on position where I add so that I run a full 1% of my account in terms of risk is at 82 the figure. So this is in the Admiral Markets account, but I'm also doing this in my own funds. Sorry for today's hiccup. I apologize. No clue what the computer did. I thank you for you showing up on a Monday morning. I hope it was insightful for you. And I thank you, Jens, for the opportunity to work with you guys. I love doing this. Have a great week. Let's make a lot of money. And a big shout out to my traders who are doing a fantastic job. I really liked your over the weekend analysis. Great job, especially you, Kalle. Guys, speak to you soon. Bye-bye.
Life is life. Now we know why this slogan is into the world. Thanks. Tomorrow is another day. Tomorrow with day trader Paul. So hope to see you again to the same time. Greetings from Berlin office. Bye-bye.